Well, good morning to you, or good afternoon. It's just midday here in Cheltenham, Gloucestershire, 17th of August. Great, halfway through August, September soon. It'll soon be autumn and winter before we know it. I'm Paul Archer. Welcome to your mortgage live stream. For those of you that wish to, and there's some music as well, those of you that wish to have updates and CPDs and CMAPs and CF6s and stuff like that. So got a great couple of topics for you today, but something tickled me last week about the economy. And did you hear in the news that the BBC, they're just going beyond their remit now, aren't they? The BBC, they reported that that we're in recession. They said, the second quarter we were 20% down on GDP, the worst since the Great Recession. And I thought to myself, what a load of codswallop. But don't these people appreciate the fact that what's going on? The government closed the economy down in March 20th, something or it was, that they closed the economy down for 1, 2, 3 months virtually. Of course we're going to have a GDP falling by a quarter or an eighth or whatever it was, 20%. Because if you close the economy down, you're going to have GDP go down. And then, of course, you get the bounce back, which is occurring now. But we're in recession. Unemployment's not looking so good for the autumn and not a good place for many people. So let's get through this downturn. And BBC, please start reporting proper news rather than your own opinions all the time. There's my rant over. Okay, let's get on to our topic for today. And we ran a course last week on the advanced, or I ran a course, or we, sounds like the royal we, doesn't it? I ran a course last week on the RO7 paper, which is the advanced mortgage paper. Pucker paper, best one going. Chartered Insurance Institute did that one. Really good advanced mortgage paper if you're looking to advance your mortgages. And we did a session on taxation, which was fabulous. So I thought I'd do the same session for you just for 8 or 9 minutes or so, just to give you an update on taxation. So, welcome to my session on advanced taxation, personal taxation when it comes to house purchase and mortgages. So let's put a title up on my whiteboard. For those of you, of course, listening to the podcast, you don't get to see this, but hey, I'm sure you'll get over the disappointment. So property taxation is what we're looking at here. And I'm going to give you an overview of property in the UK and how it's taxed. Because as a mortgage advisor, you do need to have a handle on this. You don't give tax advice, I get that totally. But you do need to understand what's happening with regards to the various taxes of property purchase. Now, I've got 3 types of property purchase that a mortgage advisor, mortgage broker would get involved in. He or she would get involved in these areas. And these are 3 ones. The first one is what I call owner occupation. Now, owner occupation is the standard stuff that we tend to do where somebody buys a house for their own benefit, to live in, to have fun. And there's 3 sort of further, or 4 further categories really. There's the principal private residence, PPR as we call it, which means that it's your own house, you live in it, a family lives in it, it's your main residence, and that has many tax breaks as well. You also got the business use or commercial use, business usage of your main residence, which of course could be a flat above a shop. It could be any kind of business use. A lot of people working from home now, of course, a lot of self-employed people based at home, and therefore you need to take a look at that kind of thing. That's a different category altogether. Down the bottom here I've got some agricultural holdings. Here we are. In other words, we're talking here about some agricultural property that's used for farming, fisheries and all those good things, and that in itself has its own category of taxation. And the last one for you, just to put it in there for you, is where you have land more than 1 acre. That in itself is a principal residence. So we're talking about occupation here, of course, aren't we? But this one, as you can appreciate, has a large amount of land, which could be a small holding or something like that, which is obviously not too good. Then you've got second category, lettings. Now I call this one lettings. Now, I got it different to the third one, which I put up there for you. The third one I call buy-to-let. There you go, buy-to-let. Hopefully that's squeezed in to the whiteboard that you can see on the screen. Now, these are very different because when it comes to taxation, buy-to-let is a formal pucker business purpose, buy a property, rent it out, full-time, part-time, Airbnb, whatever. But you've bought it to rent it. Now, a letting is where you've already had a property that maybe you had owner occupation and you decide to rent it out for whatever reason. It could be a letting here, so let's put that one in there. Letting, sort of full or partial letting, full or part-time could be the category. It could be that you've gone for a let to buy. Now, let to buy is where you have a owner-occupied property, you move on to buy somewhere else, can't sell it, so you let the property. You change the mortgage, so it becomes a buy-to-let factory. You call it let to buy because you do it the other way around. And the last one there, just squeeze that one in. We'll put it down here. Is to rent a room. You know, where you are renting a room in the house called lodgers, of course. And that squeeze is just down there. So you can just about get that down there, the renter room, just about on the video there for you. Renter room. Now, the last one, buy to let, two types really. The first one is the good old fashioned short hold tenancy. Now, here in Dagmar Road, where we are in Cheltenham, 50% of properties here are rented because that's just the way it is. And they're all rented on short hold tenancy. We had one of the Gloucester rugby players renting, actually. Old Charlie Sharples was renting the property across the road. Old Charlie, and he rented for 6 months, 6 months short hold tenancy. The other one, of course, is the holiday lets. Holiday lets themselves are very different, but they are full-time rental. Those, my friends, are the main categories, if you like, of property that a broker, he or she would get involved in. So what I want to talk about now is the taxes of each of these, and I'll verbally confirm those for you. There are 5 taxes, of course. There's 5 taxes, and I reckon we could probably squeeze those in somewhere. Let's squeeze the taxes down here, so you know which one. What about top right hand? We can squeeze them in there, can't we? 5 taxes. You've got good old stamp duty land tax, of course. You've got income tax, of course. There we are, income tax. And you've got capital gains tax. Over here, I'll squeeze in the other 2 for you, inheritance tax and VAT. Those are my 5 taxes that you should have a really good understanding of in your CMAPs, your R07s, your CF6s, stuff like that. So let's take a look at each of these elements and see where they're taxed, because I want you to get really comfortable with this area. So let's whiz over then to top left, owner-occupied property. Now, if it's your principal private residence, that means that there's no capital gains tax to pay. No ifs, no buts. If you live there full time, it's your house or flat, then you have the ability not to pay any capital gains tax. Naturally, there's no income involved here because you're not actually earning any income by living in there, are you? You're actually living there yourself. There is inheritance tax, of course, when you die, but you may have the main residence band available to reduce the amount of inheritance tax you pay. In other words, increase the nil rate band. So that's pretty much principal private residence, not a lot more to say about that one. Down here, business use. If you're using your property for any element of business use, then you need to be liable, or you will become liable to capital gains tax on that proportion. So if you run a business, for example, where I know you have a garage out the back, fixing cars, selling cars, but inside you have like a main residence, 50% or so of that property is commercial, therefore you will have a capital gains tax liability to pay on that. There's all sorts of exemptions, of course there are, but because it's business use, there is a CGT element there as well. Land of more than 1 acre, not a lot of people know this, but if you've got land that's more than an acre, a garden that is, of course, then the tax authorities regard that as kind of like a quasi-businessy thing, because we're talking there about small holdings. What you tend to find, though, is if a property has a garden of more than an acre, it gets palmed off into paddocks, and the paddocks become separate land registry entries, so they are separate properties in their own right. I know a lot of lenders won't accept a standard mortgage if the garden is more than an acre, so you need to take a look at that. Well, there are exceptions to the rule, of course there are. Agricultural holdings has its own rules when it comes to buying and selling property. You can only, if it's got an agricultural holding against it, you can only buy it if you are in the farming or fisheries trade, so that's another issue. But because it has agricultural connections to it, it's more like a farm. A farm is commercial, therefore the property will be liable to capital gains tax. But there's plenty of ways of rolling it over the capital gains tax liability to keep the farm in the same family. Same with inheritance tax as well. So that makes sense, doesn't it? Biggest one there for you, though, is the principal private residence. That gives you the ability to offset capital gains tax. Let's move on then to lettings, because this area is actually the more complex area. This is your part-time lettings. You know, you lived in the house, you're letting it out. And there's all sorts of rules going on here. First of all, rent a room, pretty simple stuff really. Rent a room allows you to receive a certain amount of that rent tax-free. I think it's about £7,500, but check the tax sheet. That's per annum. You can rent a room out to a lodger and not have to pay any income tax at all on that income. So that's a particularly good advantage. But it's good for the economy because it gets people moving around, you know, changing jobs, keeps the economy generated. So the government quite happy to do the rent a room itself. Now the letting full or part-time, that changes everything there, and there's rules around that one. First of all, there is capital gains tax. If you've lived in the house for a period of time as your main residence, then you bugger off, move off somewhere, and you rent the house out, then there is going to be a capital gains tax liability on that. Now, there are two things you can do to reduce that liability. The first one is what they call the principal private residence relief, called different things. That's the 9-month rule. Now that means that the last 9 months are ignored for capital gains tax. So if you work out the details, so you know, say half the time you had it as your main residence, the other half you had it as rental. So there is a capital gains tax liability, but the last 9 months of ownership are ignored for capital gains tax. That's the 9-month rule. The big one though is lettings relief. Lettings relief has been watered down recently. I did a video on it the other week, didn't I? Whereby if you are renting part of the property but you're still living there, you have this very clever way of reducing the capital gains tax dramatically, even if just wiping it out, using lettings relief. You need to look up details, look at the video on that topic. But it's only for when you're living there, but you're renting, say, half of the property out. It's not rent a room, it's partial letting. It used to be for people that rented the whole house out, and you've got a great way of reducing the capital gains tax, but that's now gone, and rightly so as well. The last one is income tax. If you're receiving income from letting the property under a let to buy or whatever it is, then you will be liable to income tax on that. Which now takes us beautifully on to the last point, which is buy to lets. If you're buying a property purely to rent, either on a short hold tenancy or on a holiday let, you are making a profit as a business owner, therefore you are liable to income tax. You can't escape that. So picking up on the short hold tenancy, you're liable to income tax on that. And if you're buying it in your own name, you are going to pay income tax on that. And there's very few ways of reducing that tax liability. You can offset the basic tax on the mortgage interest, not high rate tax anymore, that's gone. So you can offset a little bit of your interest on the mortgage and a few bits and pieces on costs, etc., expenses of running the business. But there's not that many ways now if you buy it in your own name. A lot of people buy these things in a company name now, a limited company, an SPV as they call it, which sounds like a police force, doesn't it? A special purpose vehicle, which reduces the tax, changes the tax regime because you get into corporation tax and things like that. But that's another video, we'll cover that in detail. There is capital gains tax on short hold tenancy, and you buy a property, sell it at the higher rate as well, the higher CGT rates for second properties, so be careful of that as well. Naturally there's inheritance tax. If you buy it in your own name, you're going to die. This forms part of your estate, isn't it? So there's definitely inheritance tax on there as well. But no VAT, value added tax over here of course. If you're renting it out as a residential letting, there's no VAT to add to that, which is great, isn't it? That's a lot of taxes there on short hold tenancy. Now the holiday let has a very different taxation regime altogether. There's income tax to pay, of course, on the business income, but there's many more ways of offsetting that. You can take off all of your mortgage interest. You can even buy capital goods and have capital allowances reducing your income tax. So there's some great ways of reducing your tax on a holiday let compared to short-hold tenancy. You don't have to set those up as a limited company. So that's great, isn't it? You can buy it in your own name and get some fantastic tax reliefs. And with everybody staycationing at the moment for the next few years, I think holiday lets are great investments. I mean, I heard at the weekend that Devon and Cornwall are full. There's a big sign saying full, no entry. They've got too many people down there. Everyone's having their holidays down there, aren't they? VAT, you do have to add VAT to a holiday let rental. Of course, there are exceptions to that one, and the Chancellor's reduced the rate down to 5% recently, so there's good things there. And naturally, there's inheritance tax to pay, but because it's more of a business, there are ways of exempting inheritance tax as well, rather than just a personal asset. So a lot of taxes there, as they say, on all of those property issues. Most brokers tend to probably deal with principal private residence stuff and maybe short hold tenancies. That's where brokers tend to get involved in. Some deal with the holiday let market, but of course once you've got a client, the client themselves may well decide to let to buy, get a second property, let to buy, or maybe a partial letting. They may come to you for advice on that one. You can give them general information. Obviously you don't give them advice. They need to go to an accountant for that one. Of course they do. You're not authorised to give advice, but you can give information, and I think you should, because it shows professionalism along the way. So there's a lovely little overview for you on property taxation. I hope that's been useful. Bye. Ha! Do you like that one, did you? Or not, as they say. It's quite a visual, isn't it, really? There's a lot going on there. Now, as I mentioned to you, in the advanced mortgage paper, they cover all of these taxes for you in a whole lot of detail, because you do need to know about them. And rightly so. The advanced mortgage paper is brilliant, actually. There's different types of advanced mortgage paper, if you're interested. The LIBF do one, but theirs is more of a sort of a university degree kind of thing, with coursework and all that kind of stuff. Takes years, costs a bomb as well. The CII do one multiple choice paper called the RO7, so that's just one paper that you need to pass to get your advanced mortgage. And it's a great syllabus, and it's all on multiple choice with case studies. So you just take the exam in the good old-fashioned way. So that's the one I tend to provide more support for, because that's the one I like. But it's my personal choice. It's up to you what you do, isn't it? Let's get into some last thing on sales, shall we? Let's talk about selling, because we talked about the recession piece, and I kind of joked about the GDP reporting from the BBC. But the pure fact is, we're going to go into a downturn, and all businesses will be affected by that, because you probably sell to people. And every person that you deal with is in different sectors, and they may have lost jobs, they may have had overtime stopped, they might be cutting back, whatever it is. So people now start to change the way they buy stuff, even if it's a mortgage, financial services, whatever it is. And the title of this particular video, nice little phrase for it, I call this required. There you go. Required, not desired. So a bit of a sort of a rhyming thing going on there. And that's the concept and what you take away really with you today. Desired versus required. What's the difference? Well, required is something that somebody needs. Desired is something that they want. So we used to call this needs and wants back in the day, and they still are relevant. So where's the issue here? Well, first of all, in a downturn, an economic downturn, hard economy the Americans call it, people don't have as much money in their pockets as they used to, and therefore they're going to be much more canny as to where they spend it. Not everybody, get it totally. Talked to my son at the weekend. He works for a software company that involves itself in cyber kind of anti-hacking software. His business is booming and will do during the recession. If you're in healthcare, you'll be booming. In IT, you'll be booming. All sorts of different places. Public sector tends to do okay. There are a lot of people with a lot of money in their pockets, but a vast majority won't. In those situations, people therefore are more choosy what they buy. They tend to steer more to things that are required, not desired. So take your average food shop. People go down to Tesco's or Aldi, whatever it is, and they'll start buying own brand goods now. They might omit the Ben & Jerry's ice cream and go for the Tesco's own, because they require ice cream, but they're going to have the lowest or cheapest version rather than the expensive one. So luxury goods tend to hit badly in recessions. Leisure choices, people won't go out so much for restaurants. They'll have more takeouts rather than going into a restaurant. They might get Sky Movies rather than go to the cinema. So different examples there. The BT Sport thing, watch Man United get beaten last night on BT Sport. Now I used to be a Gloucester rugby season ticket holder. I don't anymore. I subscribe to BT Sport, it's cheaper. So I can still watch Gloucester rugby play live in the comfort of my big telly, but I don't have a season ticket. People have things called direct debit purges. They go through their direct debits, don't they? They purge the things they don't need, or they should anyway. And things that are not required, in other words, the desired things, get killed, and they delete the direct debit. So, okay, we can understand that. So where's the issue here for mortgage advisors? Well, the issue is quite clear. When you're selling your products and services, and I say selling, then you've got to make your product become required, not desired. Or you want to segue more to required advice as opposed to desired advice. Now, I've moved my business model in the last 3 years. Since we had the Brexit vote in 2016, I knew we were going to get a recession. Therefore, I've been moving my business model accordingly. And I've done 3 things. First of all, I purged my direct debits, started doing it 3 years ago. Business direct debits, we pay for all sorts of rubbish we don't need, so I've been purging those quite considerably. Secondly, I've changed my business model, so I deliver via this kit now rather than jump in a car and go off some room somewhere delivering training which is too expensive. So my training can be a lot cheaper now, or more cost effective if you like, by delivering it via this mechanism. And I don't just sit in front of a camera laptop, with your nostrils showing. I don't do any of that with slides in the background. No, we've got proper basement here with screens and lights and cameras everywhere, different angles and all those sort of things. Got loads of that stuff going on. That's number 2. Number 3 is I've kind of moved my business area to more required delivery as opposed to desired. I do a lot of sales training. Really believe in sales training. Do a lot of sales and coaching of managers. That's helping people to be better coaches, better sales managers, better salespeople. Do a lot of that. But in downturn, guess what? Businesses don't want that anymore because that's desired, or I think it is anyway. It's actually required, but they don't see it like that. So that kind of training is going to go flat. Didn't last recession, we'll do this one too. So I've moved much of my delivery now to required things, like examination support, for example, for CMAPs, CF6s, ER1s, equity release. I've moved into the advanced mortgage paper delivery in all those areas now, using technology, because people require that. They're doing an exam or they're having some kind of authorization. They have to have it, therefore I can deliver it. I'm also doing quite a bit of sales training still and supervisory training, that sort of thing, but not as much because clients won't necessarily buy that. So that's how I've segued my business. What have you done? Here's some ideas for you. Here's some ideas for you as a mortgage broker. First of all, focus on the remortgage business. Now, remortgages are required because it reduces the percentage rate for people. Rates are rock bottom, will be for a few more years. So remortgage business is required. And people will therefore go for that. They will therefore buy that because they need to do it as well. On the same one as well, you've got fixed rates ending as well. So fixed rate mortgages come to an end. You need to move that to another product, or remortgage probably is the best thing for you. Again, that's required to reduce rates. It certainly has a need for people to do that to be able to survive dramatically. Equity release is a market area which is not a luxury. It's needed for people that need money for whatever reason. Getting equity release gives them the money and they can do what they want to do. It's not like a sort of a nice to have, it's not a desired area as well, which people will probably ignore. Desired areas are those where people want to scale up to the next property. First, second time buyer bought a property. Let's move to a bigger house, darling, shall we? Let's get a bigger garden. That's desired. It's not required. Okay, people are doing it now, a bit of a backlog of sales. But when money's tight, people ain't going to do that. Or we'll stick here for a couple of more years, darling, shall we? We won't move yet until 2 years' time when you're more secure at work. That's the kind of thing people do. So that kind of business won't be happening so much. So this stuff, though, will have a need for it as well. Protection. Make sure that you ensure that your customer sees protection as a need effectively, as a required thing. You have to turn it into something that they desire. Of course you do. You have to make sure they want it and desire it, but they have to make sure that it's required. It becomes almost essential to their daily living. Have a discussion around what might happen if, without obviously scaring people, but make them really feel that the income protection, the life protection, whatever protection you're looking at doing, is part of their DNA. They have to have it. It's required. If they don't have it, it's doom and gloom. You know, really make sure they know that it's a required thing. Wills, lasting power of attorney. These things, again, you can have a conversation with the customer, make sure they appreciate why they need it, what's the rationale for using it. When you're selling, use more logic now as well. Logical selling is much more appropriate in a downturn because it makes people notice it's required. People used to say that you sell on emotion, don't you, and justifying logic. You do sell on emotion, but not in a recession. In a recession, you have to sell on logic, make people require things. So there's a few ideas there for you. The biggest danger you've got, though, when trying to sell any of these things, and I'll put it down here for you so you can see that, is what we call the status quo. Now, status quo is not a rock band with Rick Parfitt. Oh, he died, didn't he? It's people will want just to keep what they got. They don't want to change. They don't want to do any change whatsoever. It's called status quo. So that's your biggest enemy. You know, you're talking to a customer, client about maybe buying a house, moving on upwards of the line. They'll rather stay put. You talk to a customer about remortgaging, and their rate that they're going to save is not an awful lot of money, so they'll probably just stay where they are. Status quo is the biggest danger. So you've got to get around that. And the best way to get around that is what Braceford used to call incremental gains. Now, my partner's very good at this with me, Shelley. She'll get me to make changes, but she won't do it all at once. She gives me little changes that all add up to the big change at the end. So suddenly I think, hold on, what's happened here? I've agreed to this, but she's done it in little steps. And that's what you need to do when selling. They say a rolling stone gathers no moss, but a rolling stone has to start by giving it a little push, and it starts to get going on its own. So lots of little steps. Learn to create momentum. So, for example, if you're looking to sell some protection and some wills and stuff like that to your customer, don't just have a great big meeting where you try and flog it to them. That's just ridiculous. Do it in steps. Sow the seed early on in your mortgage interview. Tell them that you're going to talk to them later because there's some really big issues here. Get them used to that. Then maybe have a 10-minute Zoom call to talk about what they've got, and maybe sort of sow the seed a bit more. And then later do it again and again and again. Little changes is how you get people out of status quo. Or of course you buy download their CDs or whatever it is you want to do, or Spotify them as well. Direct debit purges as well. People will do that, so be careful that you sell things that they know is required, because they will purge the direct debit later. And if you're selling protection, you get commission paid. You're going to have that commission clawed back, so be careful you don't call into that one. And that's what people are about. They're about saving money. They're about required, not desired. That's why Martin Lewis is money saving expert. He kicked that off in the early noughties when we had a bit of a downturn. And of course 2007, 8, 9, his money savings expert website just exponential growth, and he became a household name after that because he was helping people save money. You'll see that on the telly, how to save money here, how to upcycle your clothes. You'll see a ton of that now with people looking to keep back the pennies. So remember, when advising customers, make sure you sell required things, not desired things, or make your product a required necessity, not something they can do without. That's the key to getting through downturn. Hope that's been useful for you. Bye. Did you like that, did you? Nice one. Crikey, we've been talking for almost half an hour this morning. Hope you found this all useful. Those of you on the podcast, you get to listen to it, which is great. Good to have that on you as well. Those on YouTube get to see it as well. On the boot camp, people get HD versions of this, so they get a nice little glossy look to this as well, and loads more videos as well. We do a ton of videos for people on the boot camp. If you're looking to get your CMAPs or your CF6s or any of those courses underway, we do a ton of those for you. You just click on the button there, make sure we're recording this. There you go. Yeah, if you're looking to get your exams underway out of the way, we do a ton of these courses for you, all on video and audio. Lots of me speaking with whiteboards, explaining things. Really good price. It's not as expensive as a classroom course. You don't need any of that palaver. And our courses aren't just text on the screen. There's loads of people that do that. I think that's actually a travesty of justice, I really do. Anybody can copy and paste text from a textbook and put it on the screen for you to read. That's not online learning. That's just ridiculous. Now ours is more interactive. We have live weekly sessions on Zoom with all the people that want to attend, ask questions. I'm there live in my studio, and we had a load of those this morning, which was great. People just pile on, they ask me questions, they like to know what's going on, and I'm there to help them along the way. People have access to a year for the online boot camp. We've got one starting on the 14th of September. My good old mum's birthday, that one. So 14th of September, got a new cohort starting. Cohort members get coddled for a 3 to 4 month period because we want to get them through the exam in 4 months. So we mollycoddle our cohort members. We give them an extra half-hour coaching in the morning, so they want that on a Monday morning, plus all the other live coaching, plus all the videos, and I keep in touch with cohort members directly to push them through. I kind of encourage them through. So we've got a new cohort starting, 25 people available for that one on the 14th of September, so we're going to start marketing that. You can only get onto our cohort if you're on our database, so get on the database and then we'll email you with details. We don't just take anybody on, interestingly enough. We want people to be satisfied it's right for them, and they get to come on our database, find out what we're about, they see videos. Our YouTube channel has tons of examples, so we only want you to buy this if you're really sure that you'll want to use it as well. Not interested in those people that try and buy. That becomes desirable then, isn't it? You know, it works. That's the whole point behind it. Anyway, enough of that chit chat. Advisor@cpd.com if you want to say hi. Paul Archer, paul@paularcher.com if you want to email me. Speak to you next week.